All right. Awesome. Good evening, everyone, and welcome to this month's Hulk AMA. So just quick, all I say, like quick update before we get into the conversation. For those who are joining us for the first time, perhaps your first event, or like you just of just first engagement, welcome. Hulk, that's half of a quarter, is a syndicate. And we're a group of a community of operators and creators who again rally together to back early stage startup founders who are again building the next things that would actually again change our world, transform lives, and just again make things better. And so we've been around for about 2.5 years, or even almost 3 years in a few months. In April, and we in that span we were able to again back about 81 startups, and deployed about almost $3 million in dollars in capital. But again, pulled together a community of about 400 active investors and a wider community of about 1,000. And so we again are really big on again the need of actually rallying together and coming together as a community to do this. As African proverb goes, you can go faster alone, or you can go farther together. And so part of one of our tenets is actually enablement. Like again, we know that again, the only way you can become better at something is actually to learn, to also practice. And so we like to bring on people who been there, done that, have knowledge that they can share with us, have experience that they can share with us. And I think our guest today is none other. I mean, definitely like fits the bill. You can check out previous editions of this AMA sessions. We've had sessions with Steven from DFS Labs around like market sizing, how do you size your market. We've also had sessions around like again a winning pitch deck. So as an investor, how do you assess a winning pitch deck? What red flags or what things do you actually look out for? So check out our Medium, check out our YouTube channel as well for recordings on those. So like I said, today we're going to be looking at a very interesting topic. And with me, I have Olumide Soyombo of Voltron Africa to join us in that conversation. And so we're looking at high conviction investing. And I know again we're going to like again what does that mean? Why is that important? But again, we'll just get things perhaps on a lighter note on introductions. So Olumide, I don't know if you want to just introduce yourself, and if you missed the Benjamin Dada piece, maybe that would be a good one to go and read up on. But perhaps in a very short period of time, like just in a short version of that, in a tweet version of that, like how would you introduce yourself? Oh yeah, I'm mute by the way.
Yes, you can hear me clearly, I believe.
Yes.
Okay. So, well, glad to be here. Good afternoon or good evening, depending on where you are. Olumide Soyombo is my name. I'm a founder. When people forget I'm a founder first, right, before I started investing. I started out a software company 15 years ago called Blue Chip Technologies, building out software for most of the banks and telcos. It's about 250 people now in 6 African countries. About $70 million in revenue. And still growing. So that's my day job. That's what allows me to invest. But that's what I'm least known for. And I'm happy with it that way anyway. But then in 2014, I started took some money out of Blue Chip to start investing in startups. Right? So started out with LeadPath, which was the accelerator. We quickly scrapped the accelerator model because we saw many of those things didn't work. Because those days you could write 25,000 for 15% in the company, and then wait for demo day, but there was nobody to write any follow-on check. So you write another 25,000. So we quickly scrapped that and started doing some portfolio investments, right? So we did just register an SPV and do my own personal investments in. So we did Paystack, Piggyvest, Mono, Split, Lemonade, about 30, 40 odd companies that way. And then folks were like, hey, Olumide, next time you're investing, carry me along. We want to have different folks from corporate Nigeria, high net worth individuals, some other funds. And I said, okay, maybe it's about time I create a small fund that allows me to take an angel approach to VC investing. And that's where Voltron Capital was born in 2021 or end of 2021. And since then, we've gone on to back 53 companies in the last 1 year. So that's my story.
No regrets?
There are regrets along the way, but hey, the journey is still far.
Okay. So I think it's really great to hear that. I mean, your story, because again, many people like who know you as an angel investor, but like I said, you're a founder before. You're still a founder. You're still building a business that is scaling. I mean, you're expanding into new markets. You're launching new lines of businesses as well. And again, that's actually foiling this other thing that you're then doing. And yes, so that you started as an angel, and then now we have more like structure around things. Again, like a fund, Voltron. And so 53 startups later, I'm just curious to hear, like, what are your top like lessons or takeaway from, again, angel investor or early stage investing? Because I'll say perhaps going from the SVB model to Voltron, you've actually, again, perhaps you're more like a VC now. But I'm just curious, like, what are the lessons from, again, just your experience in getting in early into deals, into engaging with founders, and just deploying capital at that early stage?
All right, sure. I mean, I'm just going to gist, right? Because I can say I know many of the names even on this list. I'm just going to make it fun, and I'll keep it honest. I'll keep it as honest as possible.
Please.
I have a WhatsApp by my side. If I had whiskey by my side, maybe I would have kept it even more honest. But I think, you see, when I decided to even raise a fund, right? I think as in take outside money and stop investing my own money alone, right? I was doing it from a point of view of, I see a deal, right? I see maybe Mono, for example, is raising 200K. It's interesting valuation. I say, okay, I'm putting in 20K or 50K, and then I'll call different folks, right? I'll call some older friends from corporate Nigeria. I'll call some other investors. We invest along together. I will fill up the fund, right? That's what I used to do most times. And I started thinking out about a way, how do I formalize this, right? Because how many times can you keep on meeting different people? And I was doing it not for money, right? I was not doing it in a structured way. I was just trying to fill up the round for the founders. So I figured there had to be a better way to do that, and that's how Voltron was set up. Interestingly, investing and the reason why I started out, I think the first time we said we're going to take only $3 million first, right, to test it out with maybe 40, 50 companies, writing 50K checks in. And I said $3 million because my entrepreneurial mindset or founder mindset was, I want to raise $3 million, and if anybody's disturbing me too much, I can give them back their money, right? So don't disturb me and ask me any questions. It's $3 million. I can find $3 million to give anybody back if they start disturbing me too much, because I just wanted to be able to have that, still have that freedom. But the truth is, once you've taken money from anybody else, you don't have that freedom anymore, right? So with angel investing, you have that liberty to, hey, I lose my money. It's my money now. It's $20,000. It's $15,000. I won't die, right? You have that freedom to say yes quickly, right? There's sometimes you're looking about this company, you're like, yes, there are many yeses, but there are many no's too. But then you still go ahead, right? But with VC type approaching, and when you're doing some corporate venture, it's now there's an extra level of DD that obviously goes on. There's some extra level of care and diligence that you have to apply. But what it also does, that it makes it easier to say no to people that are your friends, right? Because you can easily say, hey, the fund is not invested. It's harder to say no as an angel. It's easier to say no with the VC model, I found out.
Yeah, you can always throw it to the IC. IC did not approve this. But yeah, definitely makes sense. And so let's double click on the current climate that we're in right now. I mean, we're all looking at the same screen, but we seem to be watching different movies. Some people will say, "Oh, it's time to double down on investments. Like now is the time to invest." Some will say, "Stop all investment. Just stay alive. Like bootstrap. Do what you might need to do. Revenue." In fact, I've seen investors like say one thing on Monday and then on Thursday they're saying another thing. And I'm like, "But you just said you're not investing, but now you're saying we should invest." So, anyways, let's come to you. I think it's now really subjective. And so, but then again, like I said, you started investing in, I mean, pay stocks. Like these are like, again, this is super early days. Big invest and the likes. And so you've gone through that realm of, like, again, where it was pray and pray, or it was easy to like write checks, and it was pretty much like a founder's market. And now we're in this where the table seems to be turning, or maybe like returning. Like, what's your read? Like, how would you like, as an investor, like, what's your take? What's different? What's the same? What is bad?
So,
What is good? What are the challenges? Just what's your read on the market today?
I mean, it's an interesting point to make, right? Because I mean, it was 2014. It was hard to raise funding, became easier, and then hard again now, right? And it's the cycle. It's the cycle that these things typically take. I think the way I see the market is, especially in the pre-seed stage, right? I think in terms of deal velocity, I don't know I myself and two of us talk quite often, right? We find that at the pre-seed stage, I'm still seeing a lot of deal velocity, because newbie is still newbie, right? Whether we're in a bear market or in a bull market, right? A correct guy, a super founder is still a super founder in both markets. It doesn't change. However, what we are seeing differently is, I mean, in yesterday's market, as I would call it, I've seen companies where pre-product, pre-revenue, pre-everything, $10 million pre-seed. Like, how now? How? And people did those deals, right? In yesterday's market, and all of a sudden 2 or 3 people have done those deals. Everybody wants to go ahead, and you have to have that discipline, right? And don't allow that FOMO get to you, because I wouldn't do that kind of deal, no matter who is in that deal. Because what does it say, right? I mean, you're very tempted to do those kind of interesting deals. If it's maybe second-time founder and so on and so forth, return money before. I mean, those kind of, yes, you get that kind of pass. But there are a lot of crazy things that were just happening that shouldn't really be happening, especially in the African market. So we've always focused on find them early, 2 million cap, 3 million cap, 5 million cap. And I'm not going to change that cap because we are now in a bear market. I'm not going to give a founder a $500,000 cap and mess up the cap table, right? So even, especially at the pre-seed stage, you find out that a very interesting company raising at 250K, raising 250K at maybe $3 million cap. People, sensible companies raise like that, and those are the kind of companies we backed in yesterday's market, and those are the kind of things we are still doing in today's market. The only difference now is it seems like we all forgot how to build with 200K, right? Or how to build with 250K. All of a sudden, nobody could build with that anymore. There was a company that regrettably we founded, 4 founders paying each other 2.5 million a month, 10 million naira from four C-level people, right? How would the company survive? You have not built product. So, I mean, people got carried away in that sense. And we've forgotten that a company like Hotels.ng raised a Series A of $1.6 million or $1.2 million, if I remember correctly, in yesterday's market. So today you see companies raise 250, or yesterday's market you see companies raise 250K, and all of a sudden, boom, in another 4 months they've gone again, right? Sometimes not necessarily because they need to raise, but because investors are looking for that next bump on the portfolio. So now, obviously, people have to build sustainably longer. So that 250K, you're going to stretch it, right? You're going to prove some positive unit economics. You're going to prove I can sell $8, an $8 product for $10, not sell a $10 product for $8 and grow by all means. Prove that viability and learn how to build again with little. And that's what we are saying.
Yeah.
There's a longer time to the next round. So companies who don't focus on business models with the right unit economics would then die before they can get there.
Yeah. I mean, that was what I was throwing around right when they started switching up. They were like, oh, capital efficiency. That was like the buzzword. And yeah, like I said, like, how do you, like, again, people have forgotten how to actually, like, again, have a 12 months runway on 250K or 500K. Like it's like no, it's just that's gonna be for like 3 months now. And that's born. But it's interesting like you actually mentioned that what like you're not taking that because one thing again that people have said is like, oh, investors are taking advantage of this climate to then get cheaper deals to say, oh, the deal that I would have done for like 5 million or 3 million even in the past, I will now push it as hard as I can to even 1.5, like you said, like you're not pushing down to 500K cap table. Is like it again, just going by demand and supply and going by economics, like why is that not the rational thing to do? Why wouldn't you want to look for cheaper deals and perhaps again get more for your money as an investor today?
I mean, I think with the current climate, right, especially depending, there are different ways. There is the pre-seed and seed, and then the Series A and different stages, different investors in different stages, right? You'll find to be a seed investor, to trade primarily in the seed market or Series A market, I mean, this is the very, very interesting time to do that, man. There's more bang for your buck, obviously, in resetting those terms. I'm saying that if I did 10 deals last year at $3 million caps, right? I'm probably going to do 15 more this year, right? At that same cap. There are just more deals that will be pushed to that cap. There's some deals that were above that cap last year, maybe 5-6 million, but now will be at that 3 million cap. And I'm saying, it's to what benefit, to what end does it take to give a 250K at the $1 million and then take 25% of the company now? And to what end? What does it justify if the company, if you mess up the cap table and they can't raise anymore? So I think for me, that's not, any smart investor wouldn't do that. For me, it's still to have that founder-friendly term. And I don't want to even call it founder-friendly. Let's even assume I'm being selfish. I'm not trying to mess up a deal for myself, right? So I've seen situations where some companies have gotten into YC and they've had to come back and fix their cap table, right? Because of things like this. So why do we go through that cycle where we can do things right from the beginning? So I'm saying, if I had a $3 million fund now, the likelihood that I'll do more deals at $3 million cap and $2 million cap is more today than it was yesterday. So it's still a very good time for investors to raise and deploy funds.
Makes sense. So one other question before we switch gears into just that the theme for today's discussion, which is high impact, high conviction investing. So not high impact. We're not impact investors here. But high conviction investing. I have a question in the chat from Omotayo Ayatunga. He was like, what do you prioritize when investing in early stage startups, pre-seed? Is it traction or is it a
Is it me or I've lost Nubi a bit?
It's Nubi, but yeah.
Can you hear me?
Okay, we can hear you now.
Oh, sorry. The question in the chat is like, what do you prioritize when investing in early stage startups that's the pre-seed stage? Is it traction or the depth of the idea? What does depth of the idea mean? What does that one mean?
I'm not too sure. I mean, maybe how well this person has thought out this problem statement, I guess.
Okay. How mature the idea?
That's what I would say. I mean, traction is always good. Everybody wants traction, right? But I mean, at the pre-seed stage, for me, the thing you left out is what I'll focus on, which is founder first. So I'm more founder. Who is this guy? Or who is this lady building this thing, right? How dare you build it, right? What makes you think you are the one to solve this problem? And what risk has this person taken, right? To build this. If you go to banks today, there are people with huge, plenty ideas, and with the depth of idea that is very deep. If it's depth of idea you're looking for, there are many people in corporate Nigeria with deep ideas, but nobody has, without taking that risk to come out. I'm not going to back and support that kind of entrepreneur. So for me, it's founding team first. What does this team look like? And then obviously, yes, what's this problem statement? how big can this be, and so on.
Awesome. Okay, so let's switch gears. Why this conversation earlier? Earlier in the year, you were like, okay, it's 2023. You just fully deployed Fund 1 for Voltron. You're going to Fund 2, but then you're taking a new, I would say new thesis, but you're going to be sticking more to this again, high conviction investing. So can you first just define what that means? What does that mean? High conviction investing.
Every VC, right, player, especially in the angel and pre-seed stage, right? You're backing this entrepreneur, you're backing this company, but there are many reasons not to, right? Like for every deal you've said yes to, if you really wanted to say no, there are reasons to say no, right? Many reasons to say no to every deal. Right? Even Paystack, doing the deal, there's a reason I could have said no. Piggyvest, there's a reason you could have said no. Any interesting company, there are reasons you can say no to if you really want to say no. And where we try to get to is, okay, am I trying to get to a yes or am I trying to get to a no? Right? And that balance point is where high conviction comes from. To be able to say, I'm imagining what this would look like 5 years, 10 years from now. And I'm imagining that world. And I'm trying to see how big this can be. I'm trying to also like stake my reputation, right? Stake my money, and see what it gets me in 5 years' time or 10 years' time. And it's more of I've found many reasons to say no, but I'm trying to get more reasons to yes, right? In terms of my conviction about this deal. So, when you talk about high conviction and early stage, there's really nothing high conviction about early stage if you really want to be, if you want to face it in the real sense of things, right? Because everything, I tell people that everything in that Excel sheet and everything in that deck is fiction, right? After sci-fi, they should put series investment decks beneath it as a category. Because if everything there was happening, I'll be a billionaire today. So even when I do calls with founders, after I've seen a deck, when we're doing calls, I never look at the deck again. Because everything there most likely would not happen, right? So let's just gist and talk about how you're seeing this problem. So I think it's in early stage, right? Is looking at it from a point of view of I can lose my money. I'll lose my money only once, right? But I can make 50x or 100x if this gets very, very interesting. So it's more. I mean, I was reading about some early investors in UiPath. I don't know if you know the company UiPath, the RPA company. Mm-hmm. There's a fund called Early Bird. I think Early Bird East, right? About $1 million plus to 3.6 billion, right? And you pray for the God of that return should just bless me. But they do only 3 or 4 deals a year. Right? So I have $4 million. I'm giving $1 million to 4 people, and that's it. So 4 deals a year, high concentrated bets, and say, this is all I'm doing. I'll back this company, I'll reserve capital for this company, and I'm all in with these 4 bets. It's the same thing of high risk, high reward, right? But then with those kind of approaches, they're going to say no to many very, very interesting companies. But they are betting that 1 in 4 that I get, I'm going to find that winner in there by all means necessary. Mm-hmm. So the level of diligence for high conviction is different. Mm-hmm. The entry point sometimes will be different for when you come in, and it's almost we are going to then build this company together, mm-hmm. right? Imagine if you write only 4 checks from a $4 million fund. You are going to sit down. It's different from writing for 50 checks that you can't sit down with everybody. So that's really some of the thinking that the high conviction tries to play on.
Yeah. So I think what I really like about high conviction is that it's not about like bringing in paralysis as to like making decisions on what to invest in, but really like raising the bar of like, okay, I'm going to say no to many things, but the things I say yes to, I'm then making like this bigger bet in them that would again perhaps again like allow me to, like I said, the DDs at a different level. I'm botting, and even when when I'm reading the check, I'm not going to sleep. I'm like, let's nurture
Yeah,
this.
because you see, when you think about it, right, when you think about high conviction investment, at the end of the day, there is really no good deal, right? Even any deal, I mean, I exited Paystack, there was no good deal. It's not a good, I can argue it's not a good deal because I should have given them more money. I gave some other people money that the money lost. So why didn't I give them more money? So there's no good deal. There are either companies that you should have given more money or companies you shouldn't have given money at all. So if you want to face it at the end of the day, okay, yes, you got $1 million and it became 3.6 billion. Okay, why didn't you give 2 billion? Right? So in hindsight, there is no good deal because you could have made more. But you have to then decide what is this return profile that this gives me, and what am I looking for in terms of portfolio construction to return the fund to several multiples. There's a reason why, I mean, people argue it's easier to 3x or 4x a $5 million fund. Try and 5x a $50 million fund. It becomes crazier, doesn't it?
Yeah, it does. Yeah. So just out of curiosity, because again, we've described what it is right now, but I mean, why did you choose to like again subscribe to this now? So I mean, maybe the answer is obvious, but I'd like to even hear you articulate it. So why did you say, okay, do you know what? Fund one, we need 53 deals of like 50K checks or 5K checks, but now we're going to be doing like way less deals, higher checks. Like why is it now that this actually makes sense?
I mean, it's not a matter of now I can apply the same strategy, right? But I think there are learnings, right, that you then pick out from investing in 50-something companies, right? There are things you start picking out about doubling down on your winners, okay, in terms of portfolio construction. And when you start working out with certain companies, you start matching patterns, right? You start finding patterns around, would this 50K here or with this 100K here do better for me than writing 20K in 5 places, right? And remember, when you're trying to, many high conviction investors were not high, you can't be high conviction from day one because where's your deal flow in the first place to build your reputation, right? So that needs to also be there. And it's, like I said, it's more about sitting down with looking at companies and trying to find, like I said, how do I get to yes, right? It's different from I'm trying to get to no. There are two different things. If you really want to do a deal too, there are many reasons to do the deal. And if you don't want to do a deal too, there are many reasons to not do a deal, right? So it's that balancing point that you then find conviction in. So for me, it's usually the kind of founders I would invest in. I don't think it will change. I'm just saying that I'm going to make more concentrated bets, right? If you're thinking 50K before, I probably go 100 or 150K in those companies. That's how I'm thinking about it.
Yeah, and I'm curious though, like in your, I don't know if you've made any of such bets yet. Because what I would like to like just know, like, okay, say Mr. Olumide of this new world and this higher conviction versus, like I said, if you had talked to me this time last year, I'll give you a 50K check. But again, because of this, my new, I would say again, not new, but like because of the way I'm operating right now, I'll give you a 100K check. Like what would have been the difference in your method or your process? Is it more of like, again, the founder will have done something that would have made you put them in that bucket of like, okay, let me consider you for high conviction, or is it mostly internalized for you to say, okay, once I see these flags or this green light or this, are there any things that will just make you like nudge you or like again kick that status? Okay, maybe this startup is valuable for me to actually double down on them.
Because you can remember, like I said, high conviction and pre-seed is really antithesis, right? Because there's really no full high conviction in if you are really trying to be. If you look at high conviction, really is really, oh, these guys has cash flow, they are safe bets, and so on and so forth, right? But then, if I look at how maybe portfolio construction in Fund 1 with Voltron, right, is more of, there's no company that I look back at, right? I think the way to answer your question, there's no company I look back at and say, should I have given them money as of today, or maybe to change 2 or 3 years from now. But as of today, there's no company that I look back at and say I shouldn't have given money, right? There's none. But there are companies I look back at and say I should have given more money. Okay, so that's where the high conviction should have come from.
Okay. So do you then look at patterns in those companies to then fuel your?
You have answered the question. So you're answering the questions for me. Thank you.
Okay. So I guess it's not. I conviction is not born in a vacuum. There is like looking at again like past data, past experiences to then inform forward-looking kind of. Okay, makes sense. Question in the chat here. Daniel says, how do you drop your compass to know if a deal is high conviction or not? I guess I just answered that exact question. So rely on previous data, previous experiences, and then use that to guide and inform forward-looking. You see those patterns again to say, okay, founder X matches founder Y that I would have given like 2x more funds to. Maybe I shouldn't be doing that now. And see if that actually like is the right bet in the future. So I guess you're right. Time is a very big factor in this. Okay. And then I'm just curious going forward, like again, because again I would say the flip side is like if you're concentrating your capital, your time and all on less deals, then you are saying no to more things. And then also with early stage and all, the whole FOMO. Oh, did I just say no to something like having a big one, the one that got away and things like that? How do you manage that? Again, not getting sucked in by, you said no to this person, they've gone on to become amazing, or you said no to this person, and then yes, things did not work out as you expected. So like, how do you manage that trade-off, if you will, with this new mental model?
Is it Better Ventures that has our non-portfolio? There's this VC firm.
Yes.
Right, that has our non-portfolio deals that they missed, and then how they saw the deal and they didn't do the deal.
Yeah.
Right. And I find it that if you can laugh at yourself, then it's fine. I think, especially in yesterday's market, right? There's a lot of FOMO. Right, there are many deals or companies that maybe I'll write a check to, and they are seen other VC players before, and nobody wrote a check. But now one person has written a check. All of a sudden, it's like London buses. All the checks are coming in, and you can tell those are FOMO type deals. I think it helps when you've built a reputation, right? And I stand by what I'm investing in, and I stand by my no. Even though, yes, I end up not being correct, no worries. I've been correct before. My reputation is there, and I've been correct a couple of times. So there has to be some discipline where you say it's fine, right? And I guess you can say it's fine when you've won a couple of times before. Maybe it's harder to say it's fine when you said no and you don't have any wins, or you don't have any reasons or a reputation to say no on. So for me, it's in terms of, I don't let myself get FOMO'd into a deal. I'll be lying to say if I don't think about it twice, right? To say, there are some companies I've said no before, and I've taken a look again at those companies. Is there any blind spots here? Do I think I've missed something out? But like I said, if you really think about things, there's a reason not to do the deal, and there's a reason to do every one of the deals you've done, right? So for me, it's really about, as a fund allocator, capital is finite, right? I can't give everybody money. You get? So it's still about that discipline to say, I'm not doing this deal, and this is why I'm not doing this deal. I'm doing this deal, and this is why I'm doing this deal. I'm not doing this deal because Hoke has done it. Oh yes, okay, yes, it helps that Hook has done the deal, but I'm not doing this deal because nobody likes this deal. I'm sure there are even deals that nobody has said me that, hey, Olumide, what do you think about this deal? And I'm like, I said, the deal has not, thank you, sorry, the deal has not spoken to me yet, right? So it's still, it still happens, right? And but then it makes you look around. I mean, if I get a deal from Nubi, I get a deal from Kola, I get a deal from Odun, I get a deal from a founder that I like, who's sending me a deal. I'll look twice at that deal, and that's just the truth, than a cold deal in my box, right? Because there's a level of filtration that has happened. But I'm saying I'm not going to get myself FOMO'd into a deal. And I think many people got FOMO'd into deals last year. And that's why you do a deal at $10 million cap. First time founder, pre-money, pre-everything. Because X, Y, and Y have done those deals. That deal might end up returning money, but I'm comfortable in my scheme knowing that I said no to this deal because of X, Y, Z. Nobody will die.
Nobody will die indeed. There's a questions in the chat that I when I got to get us. So Joe asks, for new investors who are, perhaps do not have like the luxury of like experience under their hood or time and things like that, are there like hacky ways or ways in which you can actually build conviction? So when you see a deal, when you see a founder, like actually just perhaps like questions you can ask, or just things that just like perhaps help you just build conviction to get to that yes or no. And perhaps you can speak from your experience in the early days. In the earlier days.
I mean, there's always has to be conviction, right? And this whole high conviction term, like I said, just stemmed from doing more narrow bets. But there has to be conviction to do any deal, okay? And so for me, the conviction is about what? It's really starts from two things for me, right? I study markets a lot. So I look at LATAM, I look at India. I can tell you the journey of many companies in India, where they were 4, 5, 6 years ago and where they are today. So in a way, right, if you want to look at what our next 4, 5 years looks like for 7 companies in Nigeria, look at what those equivalent companies look like in LATAM and India today, right? It starts to tell you something. If you want to see what today looks like, right? You already seen that today. Look at what all those companies look like 5 years ago. So I believe that in many industries, 7 companies just have to exist, and 7 companies have to be built, right? A company like Paystack had to exist in our market. A monotype company had to exist in our market. An e-commerce type player would have to exist. A niche e-commerce player. 7 companies just have to exist in different markets, even though they will have different nuances in each market. So when you find those kind of companies that have to exist and those category leaders, right? And then you meet the right entrepreneur, right? Or the person who you feel is the right entrepreneur building for that vertical. For me, it's almost like I'm already halfway there, right? Because so sometimes the entrepreneur has sent me a deck, and it's almost like, oh, I've been waiting to receive a deck like this, right? I was telling someone recently in the group, I was talking about, there was a company called Christians, a dating website that Jason Njoku backed in 2013 or something like that, right? And I was talking to Jason in the group, I said, where is this company today, right? Obviously they're dead now. I think a huge part of it was timing. But I'd always figured in my head too that building something around dating for Christians as a category was going to be very, very interesting. And we've seen in similar markets, building around certain themes and who has bought those kind of companies. So if tomorrow I find a very interesting founder building something in there, my conviction is closer to yes than it is to no, right? Because I've studied those markets and I've now found an interesting founder. So I think your conviction as an early stage VC starts from your conviction about this right founder to build this, and what is the size of this market down the line.
That's very interesting, because I mean, so I think what Shola Paystack says, the job of the founder is to build a great business, and the job of the investor is to look for great business to invest in. And so, as an investor, like you should it's okay to take it upon yourself to see what gaps exist in the market and what opportunities exist in the market. That way you then find the founder is good after such opportunity, and then you're sold on them being the right person to do that. Then it's just an easy, like, yes, I've been waiting for you all my life kind of kind of thing, and not you starting from scratch to sell yourself on the idea itself as well. So that's a really great point there. And then perhaps a follow-up question from Koya is around can you build conviction from just so in a world where perhaps it's a very new space, so you've not like done the market study or research, can you build conviction, or have you built conviction? So speaking to a founder who just educated you on like this new world, or like, oh, this new possibility, and you're like, oh wow, okay, I'm sold. Let me write a check. Is that tenable as well?
Oh yeah, it is, right? But like I said, remember we're talking about conviction and high conviction investing, right? The high conviction plays, I want to be clear, right? So that is more narrow bets and more concentrated bets. But there's conviction both ways in the thinking. I mean, I committed I committed on a call last week, right? On a call when I was talking to a very, very interesting founder, educating me about something I found very interesting that he was doing, and how he told the story about it, how I saw what he was going to build, and I committed on the call. So it's for me, it starts, I think it speaks to my previous point on you've seen certain trends and certain things around certain people who have also pictured what 5 years and 10 years looks like from them. Someone painting a picture that way, right, and so vivid, right? It's clear that this person has dreamt it, right? How do I help this person get there? It's where it becomes very interesting. And for me, like I said, it's especially when you are angel investing, and that's the beauty of angel investing, right? You're seeing things at zero, right? And imagine what they can be and how you can support them to be that. And like I said, if you lose your money, you only lost it once, right? But if you optimize for the upside, then it's 50 times. So that's how you think about some of those things sometimes.
Yeah, true. So the way I ask the question, but I don't think it's I don't think it's the one we should answer. And the reason why I say that is because when you ask an investor what they think people should be building, they are pretty much gaming the system and trying to go build. I think a founder should not be building what the investor wants to see in the world.
Answer the question. Do you think there's a missing gap or where?
No, it says on that note, what gaps or problem do you currently wish more founders were solving? So they go build a company and go pitch to you.
I mean, there are still many. There are problems everywhere now. If you look around us, right, there is logistics, problems there to be solved, and companies are tackling that problem. Is it in health? Is it in procurement? Is it in different problems? If there's anything we don't have shortage of, is those problems around talent upskilling, around the ed tech space. I think there's to be a $1 billion company built there. There's still very, very interesting problems that we've not even scratched the surface. Yeah. We've not even scratched the surface yet. So for me, it's like I said, running certain parallels with, if you study markets a lot, you can start drawing some of those parallels here with our own nuances.
I want to get your 2 cents or something. So there's something to be said about, like, okay, you having the knowledge or the experience, like the decades and the deals you've done under your belt, to build high conviction. But there's a place of also data as well. So if I know all of your experiences and all of what you've done in data form, okay, maybe they did XYZ deals and this is how much they performed. Maybe not. I don't need to know you by name, but I know Angel X did this. And we've been able to again crowdsource that information and say, okay, here's how like 1 million or 1,000 angel investors, here's what the investor put their money in, here was this their return, here's their performance, and then use that to then inform your own perhaps your own thinking or your own modeling and things like that. And the reason why I bring it up is because that's one thing that we've been thinking about at Hulk. How do we better leverage data of angel activities of members? What are your thoughts on that? Is that
playbook with, I think Social Capital tried something. Shamas tried something along those lines, right?
Okay.
And I don't think, I mean, data helps, right? But all that tells you really is there's too many data points that you would miss out, right? That you wouldn't get from, unless you're interviewing 50 angels, and then you're going through each deal with them and trying to extract that data point. Nobody does that. All you have is the output. And all that gives you, I think what it helps you with is portfolio construction. From a portfolio, trying to understand, okay, how many deals do I have to do at the $2 million cap? How many deals do I have to do at the $50 million, $10 million cap? How many deals do I have to do at the $1 million cap to return 4x or 5x?
Right.
Data points can give, the right data can give you, from knowing those kind of, from having those data points, can give you things around portfolio construction and so on. Yes. But the nuances about why deal A was done or why deal B was done, I don't know how you use data in measuring that, and how you are even able to access that data from those different investors to measure that. I'm not too sure how that works.
Yeah. Plus, there's also the many deals that you do not even do as well. That also factors also.
Exactly.
Yeah. But I just wanted to get your sense on that. But yeah, you're right. Like, I mean, it's valuable, but again, perhaps more on a like I said, construction and again, what is missing, and again, perhaps just to get comparative analysis, if you will, of okay, what else is other people doing that I'm not doing, and things like that. So we have just 8 minutes left. Let's see, any questions here? What do you think? What do you think there are missing gaps in major support for companies in the space? Most times there's more of a spray and pray and reward from ourselves. Yeah, I guess in every market you always find different strategies, spray and pray, follow the leader kind of thing as well. So there's always room for venture support, and like I think even if you take the high conviction model in place, like if you're doing less, again, you're more invested and you're providing even more support for those companies, and again, seeing how else you can help them succeed. So I think that does make sense. I don't know if you want to add anything to that before we round off.
Who, me or Joe? Was it me?
Oh no, you only it's only me there. Do you have any thoughts?
Okay. Yeah, I mean, it's I think that whole venture support play, right, is I find that, especially when I've tried the accelerator model, right, I think we try to even have entrepreneurs in residence, build a back-end team for even some of the companies. I even think those things worked, right? Especially in that early stage. I'll talk about how I think it works though. I don't think it works. I want to be fuel on fire, like Colin I say, right? I don't want to be the one starting the fire for you. But then when that fire is there, right, and is how do we make this thing engulf this whole thing, right? And then I think that's where a lot of venture support work happens, right? In terms of relationship management, in terms of skill building and upskilling, in terms of market access, in terms of and so on. I think that's invaluable, right? Especially is why I like the local and foreign play in our ventures, right? I mean, the local guys find them early. With some of the foreign players who have similar companies in their portfolio, invest in those companies. I invested in a company called NEP, right? And the same companies who invested in a similar company in Latin America then invested in NEP's follow-on round, right? I'm helping them with intros in Nigeria and so on. The foreign investor is helping them with saying, hey, this is what happened when we invested in this company in that time, and this is how they tackled this problem, right? So Those two things then go hand in hand, right? In making those companies better.
Yeah. Like I think it was Benjamin that said that the average African founder is over mentored and underfunded. So I think if it's mentorship and support, if you need it, you will get it. But let's keep money.
I mean, there's room for it, right?
Yeah, there's definitely room for it.
It's very grantish in a way than economically viable.
Yeah, very true. I think I'll just perhaps if we guys close out with any, because again, like we have folks on the call who are decided their angel investing journey. Some are thinking about getting that started in 2023. Just again,
welcome. Just pay school fees money. That's all I'll say.
So advice number one: don't spend your school fees money on angel investing. But just looking at as a whole, like perhaps any like just anything worth sharing that's like how you were personally thinking about just angel investing. I know Voton is a thing that will continue to exist, but I know you still have your angel heart on, and I'm just curious, looking into what the year will look like. Just any advice, and just perhaps any principles or things that wants to live by as you think about angel investing based on your experience and for folks.
Okay, I think for me, right, the reputation you build as an angel is one who's ready. It's literally one who's ready to help, right? And many people talk about, hey, I want to start investing. How do I see deals? I always say the way to see deals is to do deals, right? And is to first get into a position where people want. I think there's this thing on Twitter. They say, I just asked Mr. Olumide, right? Because it was more of I'm first being your guy, right? In terms of, I don't know how else to put it, in saying not being a jerk to this person because I'm giving you money, right? Is building a relationship with this person, right? Oh, this person is getting married in Benin. I'm there because I'm his guy, right? I'm not, just forget that I'm even investing in this company. And you find out that the whole reason of investing in the angel way is very personal, right? You and the founder go through, you have seen the founder at the lowest of lows. You've seen this company at its lowest of lows, and you've built a relationship with this person. So I find that a lot of angel deals that I do, I mean, it's different when you're doing it from a syndicate point of view, where you also don't have that touch, but it's usually building a relationship with that founder, having a drink, meeting up somewhere, just building that relationship as first, even friends would do. And I think for me, it's also investing. I know many people don't like to hear it, especially in the angel phrase. Investing money I can lose. That's how I started out investing as an angel, right? I mean, I don't want to lose my money. Let me be very correct. But if I lost that money, it doesn't change. It doesn't change much. The school fees will still be paid tomorrow. So it's to find those kind of opportunities. Like I said, there are many reasons to get to know in many deals. But the ones you have that conviction about the founder or the market, find the reasons to get to yes, and then write that small check that you believe doesn't hurt you. What you then find is that your quality of deal flow gets better, right? With some of the number of shitty deals that you've done, because you will get one or two right eventually, that will then lead to them introducing you. Even the ones you didn't get right could also then introduce you to some more interesting opportunities, right? I talk about Sequoia a lot, right? Sequoia is Sequoia today because Sequoia sees everything, right? If I see everything, obviously I'll make some good bets, right? So as a venture, as an investor, your real case for optimizing is optimizing to see everything or as many things as possible. If you see as many things as possible, inevitably you will do good deals.
Awesome. First of all, thank you so much for spending the last hour with us. Really appreciate it. At Hoke, like we tell people again, you can choose your path. You can be an active investor where if you want to go sit down with the founder and eat with them, wash their plates and support them. Whatever you want to do, you can go on the line. You want to be passive as well, where you can just like perhaps from the sidelines, sharing them on, deploy your capital to them. You can also choose that as well. So we have both options, if you will. We have our Slack channel for every deal where we put their ask and you can jump in and see how you can support them with what they need as well. So feel free to really be as involved as you would want to, even in a syndicate structure as Hoke. But again, Mr. Olumide, thank you so much for joining us and sharing on iConviction. We hope all of the deals that you do build conviction to make in this year do bring returns as as great returns as possible. But again, I really appreciate the time of sharing with us, and hopefully we'll be seeing you around. But yeah, thank you so much, and enjoy the rest of your evening. And for others, thanks so much for tuning in. I think we're at about 45, 70, 50 people at the height of this. So I appreciate every one of you tuning in on a Wednesday. We'll be sending the recording, recap all of this before the end of the week. We'll also be announcing our first set of deals for Q1. So Hoke Q1 23 will be coming out shortly as well. But yeah, thank you so much for tuning in and enjoy the rest of the evening.